Almost everything we know about money was taught to us by our parents or people from generations before us. Over time, economic landscapes evolve, and what might have been good advice decades ago could now be leading you astray. Welcome to Forever Finance, where we want to live our lives our way. Let's uncover some of these myths and see how they stack up against today's realities. One of the classic lines from the old playbook was, "Renting is throwing money away." The idea was simple. Why pay someone else's mortgage when you could be building equity in your own home? But today, the economic environment has shifted significantly. First, consider the cost of home ownership. Buying a house involves significant upfront costs such as deposits, inspections, legal costs, and ongoing expenses like property taxes, maintenance, and insurance. These costs can add up, making home ownership much more expensive than just the monthly mortgage payment. In many urban areas, property prices have soared, making it increasingly difficult for individuals, especially younger generations, to afford to buy homes. The average cost of houses in Australia has increased by almost 60% in the last decade. This increase has led many people to rethink the traditional advice of buying over renting. Moreover, renting offers flexibility. In today's fast-paced world, career opportunities often require people to relocate more frequently than in the past. Renting allows individuals to move without the burden of selling a home, which can be time-consuming and costly. This flexibility is particularly valuable for younger people who are still establishing their careers and might need to move for better opportunities. Another important factor is investment diversification. Instead of putting all your money into a single illiquid asset like a home, renting allows you to invest in a diversified portfolio of stocks, bonds, or other assets. With the rise of various investment platforms, it's easier than ever to start investing with small amounts of money. This can provide better returns and liquidity compared to tying up your wealth in real estate. The next outdated advice is always clear your debt before you start investing. In the past, paying off debt before investing was considered prudent. The logic was that debt, especially high-interest debt, can erode your financial stability, so it made sense to clear it first before taking on the risks of investing. However, today's investment landscape offers opportunities that weren't available before. With the advent of micro-investing platforms and robo-advisors, you can now start investing with as little as a few dollars. These platforms democratize access to the stock market, allowing you to benefit from compounding returns much earlier. Compounding is a powerful force in investing. The earlier you start, the more time your money has to grow exponentially. Let's say you wait until you're debt-free before you start investing. You might lose out on years of market growth. Instead, consider a balanced approach. Continue to manage and pay down your debt while also investing a small portion of your income. This way, you get the best of both worlds, reducing your debt and allowing your investments to grow. The third piece of advice is always make the highest repayments on your debt. Traditionally, the advice was to aggressively pay down high-interest debt first, which makes sense from a mathematical standpoint. However, modern personal finance strategies suggest a more balanced and personalized approach to debt repayment. One popular method is the debt snowball approach, which was popularized by financial guru Dave Ramsey. This method involves paying off your smallest debts first, while making minimum payments on larger debts. The psychological benefit of seeing debts eliminated can provide motivation to continue tackling larger debts. Once the smallest debt is paid off, you roll that payment into the next smallest debt, and so on. Another approach is the debt avalanche method, which focuses on paying off debts with the highest interest rates first. This method can save you more money on interest over time. However, it requires discipline, as it might take longer to see individual debts eliminated. In today's economic environment, it's important to find a strategy that works for your personal financial situation and goals. Whether you choose the snowball, avalanche, or a combination of both, the key is to stay consistent and adaptable. By doing so, you can effectively manage your debt while also making room for other financial priorities, such as investing and saving. The next piece of advice is always buy low and sell high. During the dot-com boom, it seemed like everyone was making money in the stock market by buying low and selling high. This advice, while fundamentally sound, can be misleading and difficult to execute in practice. The idea is to purchase stocks when their prices are low and sell them when their prices are high, capturing the difference as profit. However, attempting to time the market has proven to be a risky endeavor. Research shows that consistently timing the market is incredibly difficult, even for professional investors. Many studies show that the average investor significantly underperforms the market due to poor timing decisions. They often buy high during market euphoria and sell low during market downturns. Instead of trying to time the market, consider adopting a long-term investment strategy. Dollar cost averaging, for example, involves investing a fixed amount of money at regular intervals, regardless of market conditions. This approach reduces the impact of volatility and takes advantage of the market's long-term upward trend. Historical data supports the benefits of a long-term investment approach. According to a report by JP Morgan Asset Management, if you missed the 10 best days in the stock market over the past 20 years, your returns would be cut in half. This highlights the importance of staying invested and not trying to time the market. Another effective strategy is to diversify your investments across different asset classes and geographic regions. Diversification helps manage risk and smooths out returns over time. By spreading your investments, you reduce the impact of any single asset's poor performance on your overall portfolio. Today's last outdated financial advice is, saving should be your priority. In the past, the mantra was to save, save, save. While having a safety net is important, solely focusing on saving without considering investments can lead to missed opportunities. Inflation can erode the purchasing power of your saved money over time. According to the Australian Bureau of Statistics, the average inflation rate over the past decade has been 2.5% per year. This means that if your savings are not growing at a rate that outpaces inflation, you're effectively losing money. By investing, you not only protect your money from inflation, but also allow it to grow exponentially. Investments, whether in stocks, bonds, real estate, or other assets, can provide returns that outpace inflation, helping you build wealth more effectively. For instance, the historical average annual return of the ASX 200 has been 9.2%. This is significantly higher than even the highest savings account interest rate. Additionally, investing can leverage the power of compound interest. Compound interest is the process where the interest you earn on your investments is reinvested to generate even more interest. Over time, this can lead to exponential growth of your initial investment. Albert Einstein famously referred to compound interest as the eighth wonder of the world because of its incredible power to grow wealth. In today's financial environment, it's about making your money work for you, not just letting it sit idly in a savings account. While an emergency fund is essential, once you have a comfortable cushion, it's wise to start investing to grow your wealth and secure your financial future. It's essential to recognize that financial advice isn't one size fits all, and what worked in the past may not be suitable for today's economic realities. To learn more about habits of today that are hurting you financially, check out this video, and we will see you next time on Forever Finance.